A short squeeze on stocks is a bet, but unlike traditional bets, when you place this one, you don't know the odds. You want everything now, and your local Porsche dealer has the dream car waiting. So why listen to the Wall Street Journal and wait to retire rich when some guy on Reddit claims you can wake up tomorrow with it all? It might seem like a thrilling ride, but for small investors, it often ends in disaster. We're going to break down what a short squeeze is, why they happen, and why you should avoid getting caught up in one. Risk is the dominant factor when it comes to shorting a stock. When you short a stock, you're borrowing shares and selling them, hoping to buy them back later at a lower price to make a profit. But what if the price doesn't go down? What if it shoots up? That's when we get a short squeeze. But why do short squeezes happen? If you've just bought shares, the last thing you want is to be caught up in a volatile frenzy and not being able to sell you shares as exchanges lock trades to reduce the volatility. Short squeezes occur for a few key reasons. First, there's a high interest in a sell-off. This occurs when a large percentage of investors sell their shares short, creating the potential for a squeeze. Second, positive news or rumors can trigger a buying frenzy, pushing the price up and squeezing short sellers. And lastly, the most popular kind, coordinated buying. Thanks to Reddit, this is becoming more popular by the day. Coordinated buying is when groups of investors try to work together and buy a large stake in a heavily shorted stock, deliberately trying to trigger a squeeze. GameStop. Let's dive into one of the most famous examples of a short squeeze from 2021, GameStop. We all know this example, and many of us have watched the movie covering the events called Dumb Money. But let's recap. Essentially, a group of retail investors on the Reddit forum WallStreetBets noticed the high short interest and began buying shares, coordinating their buying to make sure they made a big enough impact on the share's price. The stock price was sent skyrocketing from around $20 to an all-time high of $483. The short sellers, which included both hedge fund managers and small retail investors, had to buy back their shares at increasingly higher prices to cover their positions and try to stop their losses spiraling out of control, which incidentally caused the stock to spike even more. And here's where things get dangerous for small investors. Volatility and timing are things no one gets perfect or can predict. Whether you joined in on the hype or sold positions to protect losses, most investors paid a heavy price. After hitting its peak, GameStop's stock price plummeted. Investors who bought at the top faced devastating losses. The stock price dropped from $483 to below $50 in just a few weeks. Those who got in late and didn't sell in time were left with significant losses. And with most of the squeeze happening in subreddits, investors who wanted to get in had a huge lack of information. When you're relying on forums and hype rather than solid research, you're playing a dangerous game. And possibly the biggest impact small investors face is psychological. The fear of missing out drives so many small investors to jump into a rally without proper analysis. The rush to buy is often followed by panic selling when the price starts to drop, locking in those painful losses. And the same thing destroyed many Volkswagen shareholders in 2008, when the company briefly became the world's most valuable automaker. After Porsche revealed, it held a large position of 74%. But when the share price was eventually corrected, many small investors who jumped on the bandwagon ended up buying at inflated prices and suffered massive losses. Small investors like you and me are normally the ones that walk away with the smallest gain and the most amount of pain. But how can we outsmart serial investors at their own game? The key is investing in companies that you believe are a sound investment. Sometimes, not listening to the latest news on Wall Street allows you to focus on finding better investments. Ignoring the noise and hype around certain events allows you to take a better and sustainable approach to building wealth. Back in January, Nvidia hit its all-time high. Many investors advised against buying the stock, as they saw the stock as unlikely to go any higher. But I bought the stock, as I felt it was only the beginning of the long-term growth the company could achieve. Currently, in May 2024, the stock is up another 95%. While the idea of profiting from a short squeeze might seem exciting, it's a highly risky strategy, especially for small investors. The volatility, lack of timely information, emotional pressures, and potential for market manipulation often lead to significant losses. Instead, consider focusing on more stable, long-term investment strategies. Diversification, thorough research, and investing in fundamentally sound companies are key to building wealth sustainably. Comment below your best trades so far this year. Maybe we'll feature them in a future video. As another week begins, let's get out there and swap hype for real value, making trades in companies we value and not put money in what another bot on Reddit tells you will make you the next Mark Cuban.